Hello and welcome to Active Finance YouTube channel. Hope you will be fine and having fun with knowledge. As we have completed 2 chapters of this course, accounting principles, and now we are going to start 3rd chapter of this course. As in first chapter we did some neat formulas about net income is equals to revenue minus expenses, and in 2nd chapter we did certain rules of recording revenues and expense transactions. So in this chapter we will learn about the adjusting the accounts, and this chapter is based on 4 learning objectives. So we will learn about how to adjust the revenues and expenses during the continuing operations of the business. So let's get started. Alright, welcome back. So this is the 3rd chapter's learning objectives. In this tutorial we will just cover the first learning objective. First is explain the accrual basis of accounting and the reason for adjusting entries. In second learning objective we will have to prepare the adjusting entries for deferrals, and in third learning objective we will prepare the adjusting entries for the accruals, and in last learning objective we will have to describe the nature and the purpose of an adjusted trial balance. In first learning objective, first of all I want to ask from you guys that if we could wait for preparing financial statements, we will wait for making the financial statements until the company ends its operations. So you will say no, because the time is very important that company continues its operations. We will need the adjustments would be needed here, and at that point what we will have to do, how we will prepare, then how we will adjust the accounts, so we could easily determine its final balance sheet and the amount of lifetime income it is earned. However, most companies need immediate feedback about how well they are doing. So managers and companies need immediate feedback when they are continuing its operations. They need the financial statements, updated financial statements, so that they can evaluate their self, that how well they are performing. There are 2 examples that we will need to adjust the accounts. In first example, mostly management wants monthly financial statements to check their performance, and in third example, the internal revenue service requires all businesses to file annual returns. That's why we will prepare the financial statements and need the immediate feedback to how we are doing the operations of the business. Therefore, accountants divide the economic life of the business into artificial time periods. So the accountants, to adjust the accounts, accountants divide the economic life of the business into artificial time periods. It is also known as time period assumption, or alternate terminology which is used for this is the time period assumption is also called as periodicity assumption. So there is, in different books there are different names, so we will have to understand these things. These are small things that but makes confusion, so that's why I make your concepts more clear. So many business transactions affect more than one these arbitrary time periods. So in different time periods the business transactions affects more. For example, here the airplane purchased by BAB airline for 5 years ago are still in use. That airplane is still in use, so we must determine the relevancy of each business transaction, that how much it is relevant to the specific accounting period. For example, how much the cost of an airplane contributed to the operations this year. So this is totally different from the financial statements. This we have to immediate uh, answer to the management. If they will ask that the airplane which we have purchased 5 years ago, what is the contribution of that airplane in the operations of this year, so we will immediately adjust the accounts in our financial statements. Fiscal and calendar years. Both small and large companies prepare financial statements periodically in order to assess the financial condition and result of operations. Accounting periods are generally prepared as monthly, quarterly, or a year. So monthly and quarterly time periods are called as interim periods. So they, if we are preparing the financial statements monthly or quarterly periods, so it is known as interim periods. Most large companies must prepare both quarterly and annually financial statements. So most large companies prepare their financial statements quarterly and annually. And now what is different between fiscal and calendar year? In fiscal year, accounting period that is 1 year in length. So it depends upon company that when it starts, but the company have to complete that year in length of 1 year. And what is now calendar year? In calendar year, companies start their accounting period from 1st January to December 31st. So the difference between fiscal and calendar year is the company in fiscal year starts from any month the management wants, and in calendar year company start its accounting period in 1st January. So note, the observation tells us that most businesses use the calendar year from 1st January to 31st December as their accounting period. So most companies use the calendar year. Some do not. Many businesses use the calendar from January 1st to 31st December as their accounting period, and some do not use it. It depends upon company and it varies from company to company. So we will have to understand, if we are making the monthly and quarterly, it is interim periods, and fiscal year is in 1 year's length, and calendar year starts from 1st January to 31st December. So the major topic of this learning objective is accrual basis versus the cash basis accounting. So in accrual basis accounting, the transactions recorded in the period in which the event occurs. So when the transaction occurs, even we have not paid that for that transaction, operation, or whatever, so we will record that transaction. Companies recognize revenues when they perform the services. So it is recognized when we perform the services rather than when they are received the cash. So they will record their transactions when they are performed. So similarly, expenses are recognized when incurred. When the expenses incurred, we will record that expenses rather than when they paid. So in accordance with generally accepted accounting period. So according to the GAAP, we will have to record the transaction when it occurs. So in accounting we have learned in first chapter. If you haven't seen that first chapter, kindly watch. The link is below given in description box. In GAAP, they are the standards that we will use in accounting. So in accordance of GAAP, we will record the transaction when it occurs. Now, what is the cash basis accounting? So, revenues recognized when the cash is received. We have performed the services, and when we receive the cash, then we will record that transaction as, so we will record the revenue when we receive the cash. And similarly the expenses are recognized when cash is paid. When we will pay the cash for the expenses which are occurred, then we will record that expenses, so it needs the adjusting. So in cash basis accounting is not accordance with the generally uh, accepted accounting principle called as GAAP. So it is not accordance with the GAAP. The cash basis accounting is totally opposite to the accrual basis accounting. So when we will paid or when we will receive the cash, then we will record that transaction, rather than in accrual basis we, when the services we perform or in expenses occurred, we record. So it is totally opposite to the accrual basis. We have understand the difference between accrual and cash basis accounting. Now, how we recognize the revenues and expenses. It can be difficult to determine that when to report the revenues and expenses. The revenue recognition principle is used, and expenses recognition principle help us in this task. So these two terms will help us, and we will analyze through these principles that when we will have to record revenues and expenses. So revenue recognition principle, so it tells us that recognize revenues in accounting period in which the performance obligation is satisfied. When the obligation is satisfied, uh, in which the performance obligation is satisfied, then we will record the revenue. So what does it mean? It means when company agrees to perform a service or sell a product to a customer, it has performed its obligation. When the company meets this performance obligation, it recognizes the revenue. Therefore requires that companies recognize revenues in accounting period in which the performance obligation is satisfied. And when customer request for services and we will receive the cash, then we will recognize the revenue. The expenses recognition principle, it tells us how when we need to record the expenses, when match the expenses with the revenues. What does it mean? We will have to match the expenses with revenues. Which expenses are associated with the generating of the revenue in the period when the company makes efforts or generates those revenues. So we will match the expenses with revenues, that which expenses are associated with revenue, that we will, like we are developing a product, that there are utility expenses and other uh, direct costs, indirect costs are associated, that we will match these expenses which are used in delivering the revenue. So we will record that when they incurred, we will record that expenses. That's why let the expenses follow the revenue, so it follows the revenue. Now this is the gap relationship in revenue and expense recognition. It is the relationship that how they are associated. So first is the time period assumption, in which the accountants divide the economic life of the business, which can be divided into the artificial time. Once they have divided the art in artificial times, that we have learned that in monthly or any other time period. So this is the expense recognition principle, and this is the revenue recognition principle. So in expense recognition, we match the expenses with the revenues in the period when the company makes efforts to generate revenues. So when this thing is done, we have recognized the expenses that which are, so these are the connected. If we have if the revenue is recognized in accounting period in which the performance obligation is satisfied, then we will see the expenses followed the revenues. As we have learned in previous slide that expenses follow the revenue. So this is the graphically presentation that when the expenses are incurred and they follow the revenue. So at the end, this is the revenue and expense recognition in accordance with the generally accepted accounting principle. So this is the relationship showing between expenses, revenues and time assumption. The need for adjusting the entries. Why we need to adjust the entries? In order for revenue to be recorded in the period in which the services are performed and for expenses to be recognized in period in which they are incurred, companies will make adjusting entries. So adjusting entries will ensure that the revenue recognition and expense recognition are followed or not. That's why we will need to adjust the entries, and necessary because the trial balance may not contain up to date and complete data. So it is necessary because if the trial balance not contain and complete data, so required every time a company to prepare financial statements. It is needed in companies that when they required, it will have the accountant will have to prepare. So will include one income statement account and one balance sheet. So these are the major two financial statements. That's why we will adjust the entries. So these are the types of adjusting entries. Here we will write types of adjusting entries. So these are the types of adjusting entries. First is deferrals and accruals. So in deferrals, the prepaid expenses, the expenses which are paid in cash before the use or consumed expenses, so they are known as deferrals. They are coming in the category of deferrals. And unearned revenue, the revenue, the cash which is received before the services are performed, so they are recorded in deferrals. And accrual accrual basis accounting, accrued revenue, in which revenues for the services are performed but not yet received cash or recorded. Accrued expenses, so in this, expenses incurred, they are incurred but not yet paid in cash, so are recorded, so they are coming in the deferral and accrual basis. Now this is the adjusted trial balance. Each amount is analyzed to be determined whether it is completed and up to date. So this is the trial balance of BAB Advertising Company. So this is the trial balance of this company and this is the date provided. Similarly, as we have learned, we will provide here the all accounts which are used in trial balance. So these are the cash, supplies, prepaid, insurance, or equipment and equipment. So they are assets that's why they are recorded on debit side. So they will be recorded on debit side. And notes payable, accounts payable, unearned revenue, they are recorded on credit side. and honors drawing. If it increase, it is recorded on debit side. That's we, and similarly these are, and this is the, at the end we will balance the all amount if they are equal, that so it is done and it is okay. So these two amounts are similar, that's why it is perfect. We assume that BAB uses an accounting period of 1 month. Thus, the monthly adjusting entries are made. The entries are dated as October 31st, 2017. So this was all about the first learning objective of third chapter, and stay connected for the coming learning objectives. And kindly like and share video. If you haven't subscribed yet, kindly do subscribe and click on the bell icon for getting latest uploads. Thank you. We'll meet in next learning objective. Take care.